Today we're going to talk about how our banking system actually works. So hit that subscribe button and turn on that notification bell so you stay educated on how your money works. Fractional reserve banking is the practice of holding a portion of customer deposits in bank reserves and lending out the remainder. Money that would otherwise be idle in bank accounts is circulated, and funds from small deposit are pulled to make loans. This system allows the bank to invest your money and still show the funds sitting in your account. It's a core tenet of banking and one way to influence the supply of money and grow the economy. In the US, the Federal Reserve sets a reserve requirement, a minimum that banks must actually have set aside. Banks must hold that money as cash in vaults or as deposits with Federal Reserve banks. Until recently, for financial institutions with more than $124.2 million in liabilities, the reserve requirement was 10%. In other words, those banks can lend $90 for every $100 their customers deposit. The Federal Reserve made history on March 26, 2020, when it dropped reserve requirements to zero. So how does fractional reserve banking actually work? The supply of money grows when banks show money as deposits while simultaneously lending the funds out as loans. When you deposit money into your account, the bank shows 100% of the money in your account balance. But the bank is allowed to lend 90% of your deposit to other customers, so this almost doubles the amount of money in the economy. So let's assume we create a brand new economy and you add the first $1,000 to the system. First, you deposit $1,000 into a bank account. The system now has $1,000. Second, the bank can lend 90% of your deposit or $900 to its other customers. Those customers borrow the full $900 and you still have $1,000 in your account, so the system technically has $1,900. Customers spend the $900 they borrow, and the recipients of that money deposit $900 into their bank. That bank then lends out 90% or $810 of the new $900 deposit. Customers borrow the $810, you still have $1,000 in your account, and the recipients of the first $900 still have that money available in their accounts, so the system now has $2,710. $1,000 plus $900 plus $810. The cycle known as the money multiplier continues and continues over and over again. So then let's switch and talk about the dangers of a bank run. Fractional reserve banking works because people typically don't need access to all of their money at the same time. You may have $1,000 available in your account, but it's unlikely that you'll withdraw all of it at once. If you do, the reserves from other customer accounts should be enough to cover your withdrawals. Things break down, however, if everybody in the system withdraws their money at the same time. This is often referred to as a bank run. When customers fear that a bank or the banking system as a whole is in financial trouble, they flood the banks with withdrawal demands. If this happens, the money is not there to satisfy the request, so the bank becomes insolvent. Bank failures during the Great Depression were catastrophic for those who lost their life savings in bank accounts. As a result, the Banking Act of 1933 established the Federal Deposit Insurance Corporation, FDIC, which protects deposits in participating banks up to a certain limit. So then what are alternatives to fractional reserve banking? Critics have likened fractional reserve banking to a house of cards. They worry that there's nothing to back the assets in the system and the economy may eventually collapse or market participants will lose confidence in the system. These concerns are only amplified now that the Fed has reduced reserve requirements to zero. The alternative to a fractional reserve system is a full reserve banking system in which banks keep 100% of all deposits on hand at all times. This could apply to all deposits or only ones intended for immediate cash needs, such as checking and savings accounts. The more strict the requirements, the less cash is available for lending and circulating in the economy. One thing is for sure though, without fractional reserve banking, your relationship with banks would look a lot different. Instead of paying you interest on your deposits, banks might actually charge you for their services. In the system you're used to, banks earn revenue by putting your money to work and keeping the difference between what they charge borrowers and what they pay you as the depositor. A full reserve system would have to find a way to compete with this setup. So what are your thoughts? Do you agree or disagree with a fractional reserve banking system? Leave a comment down below and let's get a discussion started. And as always, take care of your money. Today's book of the day is Post-Corona by Scott Galloway. I'll leave a link to the book down below, and if you prefer listening to it on an audiobook for free, I'll also leave a link to a 30-day free trial to Audible. You can choose this book or any book to listen to, and even if you cancel before your free trial is over, you can still keep the book and listen to it whenever you want.